Dear students, we will do a new module, module 84. This is titled Carry Forward and Set Off of Losses or Set Off of Brought Forward Losses. So, theoretical explanation, and I will be doing one problem as per the old regime and the new regime because there is some changes in the rules for carry forward and set off of losses. So, what do you mean by carry forward of losses? See, carry forward of losses meaning, first we have seen that in the last module, certain losses. See, if a person is having three businesses, two are making profit, one is making loss, or three house properties, one is loss and two are making profit. So, within that head of income itself, they can adjust that. Imagine if it is not possible to adjust within that head of income, or whether interrelation adjustments are possible. I told you salary can be adjusted against loss from house property. Like this, we used to adjust. So, both these ways of adjusting are not possible. We can carry forward to the future years. So, this is advantageous to the SSC. So, the idea of income tax department is to be honest and everybody should submit the tax returns. They have to be honest, they have to submit their tax returns. So if they are giving more provisions, more relaxations, people will come forward to file the returns. So carry forward, if set off of loss is not possible within the same head of income or with other heads of income as allowed by the provisions of the Income Tax Act, it can be carried forward to future years. So carry forward of loss means a loss incurred in one financial year can be set off against an eligible income of future years to reduce tax liability subject to provisions of the Income Tax Act 1961. Now, which are the losses that can be adjusted? Loss under income from house property, loss under profits and gains of business or profession, loss under the head capital gains, loss under the head the activity of owning and maintaining race horses. Now, there is a time limit. It is two types are there. One is loss can be set off for 8 years. One is loss can be set off for 4 years. So, the time limit we will see. First is house property. House property can be carried forward for 8 succeeding previous years. It can be against house property income only. So this under the new tax regime also you have to remember that house property, it cannot loss from house property cannot be set off with anything else. It can be adjusted only against the house property. Second is business loss from non-speculation business. See, speculation business is different, non-speculation business is different. So the rule is that it cannot be set off under salaries. Then it can be carried forward for 8 succeeding previous years. Now against speculation and non-speculation business income. Next is speculation loss. See, it can be adjusted against speculation gain, speculation, gambling, betting, all that. Carried forward for 4 succeeding previous years. Next is short-term capital loss. It can be carried forward for 8 succeeding previous years and it can be set off against short-term capital gain or long-term capital gain. This is an important point regarding short-term capital loss and long-term capital loss. Long-term capital loss, you have to remember, it can be adjusted only against long-term capital gain. But if it's short-term, it can be adjusted against long-term and short-term. Now, so long-term capital loss, it can be set off only against long-term capital gain. It can be carried forward for 8 succeeding previous years. So, the time limit is same for short-term and long-term, but the adjustment is different. Now, expenses incurred in maintaining of race horses can be set off against income from maintaining race horses and then can be carried forward for 4 succeeding previous years. And carry forward and set off of loss from a specified business. What is specified business? Specified business, capital investment related to infrastructure, hospitality, hospitals, hospitality meaning 2-star and above, hospital meaning above 100 beds, then warehousing, logistics, all this will come under specified businesses. So loss can be carried forward to an indefinite time against profits and gains from specified business activity. So these are the rules for time limit for set off and carry forward of losses. This is an important question for theory examination. Theory question. As a theory question for an examination, it's an important question. Now those who are not comfortable in doing the problems, you can learn the theoretical aspects so you can get more marks. Now what do you mean by unabsorbed depreciation? You know that businesses can charge depreciation for all the assets. So if the profit depreciation which remains unadjusted, as either there is no income or less income in the relevant previous year, all assets they will be charging depreciation. So if less income is there or income is not sufficient to adjust all the depreciation, it can be carried forward till it is adjusted from any income during the succeeding previous years. This I am talking about the old tax regime. It is treated as depreciation of the succeeding previous years. So it's very advantageous to the business people. Now, as per the new tax regime, they are not allowing this. If excess depreciation, when you shift from old tax regime to new tax regime, what they are doing, unabsorbed depreciation is added with the written down value opening balance. So that is how they are not allowing it to adjust. Earlier, this was a very good provision under the old tax regime. Now, order of set off of carry forward of business loss as well as unabsorbed depreciation. So here, if both are there, unabsorbed depreciation is there, set off of business loss. What should be the order? Then the order for set off will be as follows. Firstly, current depreciation. Secondly, brought forward of business loss. And thirdly, brought forward unabsorbed depreciation. This is the order for set off. Now, one problem I will do as per the old tax regime and the new tax regime. So, you will understand the difference. So, compute the gross total income from the following particulars given below. Compute the gross total income under the old tax regime and the new tax regime. So, house property, loss from self-occupied house property 30,000. Income from let out house property 16,000. Balance to be adjusted with other income 14,000. Profits and gains, business loss 1,50,000. Now, share of loss from partnership firm. It cannot be adjusted with individual income under the old and new tax regime. So, you have to remember that. Even if it's given in the question, it cannot be adjusted. So, business loss to be adjusted with other incomes 1,50,000. Now, capital gain, long-term capital gain 4 lakhs is there, but short-term capital loss 2,40,000. Now, how we will do as per the old tax regime? Let out house property income. House property income 16,000. 16,000. Now, let out house property income 16,000. Loss from house property. Loss from house property 40,000. 40,000. Now, it is adjusted 16,000 minus 40,000. You are getting 14,000 loss here. So, first item we have adjusted. Second is business loss 1,50,000. Business loss 1,50,000. 1,50,000. 1,50,000. This share of business firm loss is given, but it is not possible to adjust as per the old tax regime and the new tax regime. So the loss will continue here 1,50,000. Now the third item is capital gain. Long-term capital gain is there. LTCG 4 lakhs is there, but short-term capital gain value is 1 lakh 2,40,000. 2,40,000. You have to remember, long-term capital loss can be adjusted only with long-term capital gain, but short-term capital loss can be adjusted with long-term and short-term. So here you can adjust. This is the loss. So here 1,60,000 is the profit. 1,60,000 is the profit. Now your gross total income. Gross total income is nil because this is loss is 1,64,000. Profit is only 1,60,000. This is as per the old tax regime. Now, as per the new tax regime, if you will see, so you have to see that loss from self-occupied house property 16,000. Self-occupied house property interest and loss are not allowed to set off under new tax regime. So, loss from new tax regime, loss from house property 16,000. 16,000. So, loss from let out house property. Income from let out house property. Income from let out house property. 16,000. Now, second is that business loss. Business loss 1,50,000. Business loss 1,50,000. Partnership loss is there, but it cannot be adjusted against the individual income as per the old and new tax regime. Now, capital gain. Capital capital gain, LTCG 4 lakhs, LTCG 4 lakhs, short-term capital loss, 2 lakh 40,000. So here net effect is 1 lakh 60,000 profit. Now you have to remember, see, loss is 1 lakh 50, but profit, if you take, it is 1 lakh 60 plus 16,000. So your gross total income is 26,000. So this is as per the new tax regime, because there is difference between old tax regime and the new tax regime. This is what I wanted to explain in this module. Happy learning. Thank you.